Lots of buzzing stocks, but guess who's in the studio? Sandip Sabharwal to talk about what he's making of the market. Sandeep, great to have you on the show. Good morning. And Sandeep, seems that all-time high cheer fizzled out very quickly, and then there was no cheer because there was no broader participation.
Yeah, so I think what's happening, Aisha, is that broader participation has been lacking, and I think there are two factors to it which I can figure out. One is that there is a continued foreign investor outflow. So, because foreigners are continuously still selling 2,000 to 4,000 crores on an average every day, which is quite unnatural. If whoever has tracked Indian equities for so many decades also, we have never seen this phenomena. So, there is a clear reallocation from India to Korea, China, Brazil, etc. If you see the flows in those countries, that's huge. And second is this constant flow of IPOs. Now, what that does is, because these IPOs, then there is a high GMP of these IPOs. So, many of the investors who as it is are not making money in the broader market. So, what they are trying to do is just put money into these IPOs, hope to get some allocations, and the liquidity is just, the entire liquidity is just going there. Because if there is 30,000 crores of IPO this month, and let's assume each IPO is subscribed by 50 times. So, you can see how the amount of money that's getting blocked.
Sandeep, there was a time when big IPOs used to come and we used to say that, oh, does the market have enough liquidity pool to manage those absorb those kind of IPOs? Now it seems the other way right? Foreign investors, do they have the liquidity pools to absorb IPOs as well as invest in the secondary market? So there is this issue which is now coming in, right? Domestic market flows are coming in $4 billion every month, and those are going into IPOs and secondary market, but for those are either churning from secondary and going to the primary, or the other way around.
Yeah, that's what is happening. If you see foreign investor flows, there's a net inflow in terms of what they are putting in IPOs, but there's a huge secondary market outflow, and that phenomena has been continuing for a long time. And that's just because most of these IPOs tend to list higher, and subsequent performance of most of them has not been great, but then at least that listing pop is there. And plus with these entire anchor investor book, so many of the large funds tend to get allocations, and then they are happy with that. So when it will reverse, what will happen, I don't know, but overall macro wise India is well placed for next year. So how the overall markets will behave, we'll need to see.
Have you been a subscriber to any of the recent IPOs?
Actually, Aisha, what happens is that people who have been so old style investors find it very tough to invest in these IPOs. Yeah, because for a company which has no visibility of profits, then you build a market cap of 1 lakh crores, and then you say that they'll make some profits 5 years hence. Like most of the company managements are not able to predict what they'll do next year. So how do we know what they'll do 5 years hence? So that's the biggest issue I face. In any case, they are oversubscribed so much. Even if you subscribe, you won't get much.
Get anything.
Sandip, I know that you're a contra investor and a big voice in terms of being a contra investor. So in terms of consumption, we've seen some auto stocks do really well. We've seen some of those numbers hold up also quite well for the month of November. What's your take? Can this sustain? Can it be the next couple of years be really good years for auto?
Yeah, it should be, because see, typically if you see historically also, you evaluate consumption cycles. If you go through 2-3 years of slump, then when the revival starts, typically it should last 2-3 years. And this time we have an additional kicker in terms of the GST cuts, plus the interest rates also have trended down. So everything is in favor of auto companies. And what's also happening is it's trending up also. People want to buy more premium cars. So, it's a phenomena which actually happens, that because people think that things have become cheaper, they don't really want to buy that cheap thing. They want to upgrade and buy a better model. And I think that's helping many companies, especially like Maruti, etc., and even M&M. Because M&M, in terms of coming out with new models, making them a success, has been one of the leaders. It's been underappreciated for some time. Now it's being appreciated because of the success of the model. So I think the trend will continue. I think next at least 12 to 18 month cycle for auto should be positive.
But at this price, someone has to buy an auto stock. Which one would it be?
See, we've been holding M&M, Maruti for a very long time. So I think those will continue to do well. We could have a positive cycle starting in commercial vehicles. So it's possible Ashok Leyland could do well because it did well, then it stagnated for a long time. It started to do well, and two-wheelers also should do reasonably well. Now some of those stocks have moved up, but I still think that the two-wheeler companies should also do well.
Rajesh, do you have a view with regard to the auto space? Any favorites within that pack that you're liking on charts?
So I think from two-wheeler space, Hero Motor is looking very attractive. The way stock has moved up in last couple of months, and stock is making a series of higher top, higher bottom formation. I think this stock has potential to extend its gain. On the downside, 6150 is the important level for near-term trend, and I think if it continues to hold this level, possible up move towards 6500, even 6600, we could witness for Hero Motor. Again, Bajaj Auto is also showing same sign of buying it and interest in last couple of weeks. So Bajaj Auto is also looking very promising. And one stock that we are holding bullish view, that is Ashok Leyland. Stock is almost enjoying its all-time high trajectory, and the way outperformance is there across all time frame, we believe that this stock may continue furthermore upward trajectory, and we could see a target of 180 to 185 on a positional perspective. So buy and accumulate would be the strategy for Ashok Leyland. On the downside, the 150 needs to keep as a stop loss.
Okay. How else are you playing consumption, Sandeep?
So we have also been buying some of these other consumption companies, like the typical FMCG ones. So like Dabur, Godrej Consumer in small proportions. On the entertainment side, I like this company Wonderla Holidays because I think they have come out with a new park also. I think that will be a good driver, and it's also trading at 52-week lows. So many of these stocks have no interest from investors right now. So that gives an opportunity to accumulate cheaper.
What about interest rate, sensitives? Because we have an MPC meet which is coming up on Friday. Expectation is 25 bips, but this recent data suggests that the RBI can go for a pause as well.
So actually data supports a cut because see, the central bankers or the monetary policy authorities need to look at inflation only. So if they look at inflation only, we are actually in deflation if you remove gold and silver out of the CPI. So they should be cutting rates. But there are a lot of armchair economists, etc., who are advising them that it impacts the value of the rupee. Rupee appreciation per se is not negative when you need support for your exports. And I think the drivers of the rupee are much more different from interest rate differential. It's more to do with the US deal. Whenever that deal happens, we'll see the rupee actually reverse. So I think the jury is still out whether they'll cut or not, because RBI tends to play conservative. So let's see.
We've seen a rupee depreciating by nearly 5% in this calendar year. If and when the US deal happens, do you think rupee appreciating by the same amount?
The same amount will not, and it should not, because we don't need a strong currency because we are a trade deficit country. A trade deficit country, so it's more macroism that you should have a strong currency, but you should have a strong currency when you have a trade surplus. But till you have consistent trade deficits, you need a weaker currency. So I think the rupee, from a 5% appreciation, next year could be a year where if the trade deal actually plays out, we have no depreciation. I think that's the best case. A stable rupee in an entire calendar year, and that could be a real possibility next year.
Is the currency and the trade deal also a big overhang, you think, because of for FIIs to stay out?
Yeah, so typically foreign investor flows follow the trend. So what's been happening is that you see the biggest flows, if you analyze, have gone into South Korea this year, and that's been driven by reforms which happened once the elections happened and new leadership. So you look at the kind of flows Korea has been getting, like it's very disproportionate. Like there have been months where they've got $10-15 billion also in a single month. And then the entire AI story that India has no AI plays, and then many of these countries have AI plays. So and then obviously the tax impact, once the taxation on capital gains got increased, we saw that the big outflow started from then only. So some of these things will moderate. Eventually there comes a stage where the valuations also adjust, and so I think the reversal will happen at some stage. When it will happen, it's tough to predict.
Okay, we'll continue that conversation, but we're going to slip into a very short break. So on the other side, we'll continue to talk stocks as well as themes with Sandip Sabharwal as well as Rajesh Palvia. Stay with us.
You're watching the market, and we have Sandeep with us. Sandeep, defense stocks, they've been doing pretty well this year. What is your view on them? And some of them like HAL, BDL, BEL actually.
So we own BEL for a long time because I believe that's the most credible player and established player, because it has a proven track record of execution, and plus among the entire defense product basket, I think the missiles program is the most successful one, and they are big players there along with Bharat Dynamics also. So I think BEL is what we have actually played, along with some private sector proxies which have defense, but defense is still not a major part like Bharat Forge, etc., which had fallen to very low levels, so it presented some value. So I believe defense investments will continue to remain strong. How we play it is something we have to see based on the price at which we can buy. So even now, I think many of the stocks are not really cheap, but shipyards is one thing which is also very interesting. So, but it depends on the price. If we get at the right price, then I think, because they have a clear 5 to 10 year visibility of growth.
What's the right price therefore? What's the kind of range? Okay, I'll rephrase that. What's the kind of range that one looks at when you're looking at shipyard stocks? Because currently they're trading at 50 times plus in terms of price to earnings.
So I don't think they'll become very cheap because of the kind of order books they have and the order flows which are there. So I would think that if the P ratio is 50, so mostly 30 odd times should be a reasonable valuation, and that 30 can come in two ways. One, with time, because as the earnings grow, the valuations reduce, and if the stock price does not move up, or if there's a market correction and the stocks correct. So both ways we can wait and see when we get our prices.
We saw something similar happening in some of the consumption stocks like a Trent and the Titan, where we were waiting for the P to come or a time correction to happen, but it never happened, and it just went up and up, right? I mean, do you see similar thing happening in defense stocks as well?
It went up and up, but then people who did not buy at abnormal valuation did not lose out. In the equity markets, a lot of times it's not about making huge money in what you invest. It's also not losing money in what you buy at the wrong valuation. So some people might have bought Trent at 8,000, but today it's 4,000. So then you lose out 50% in a company which is actually very good. In a very good company also you can lose money if you buy at the wrong price.
Agreed. But we'll pick up on that point on Trent. But first, here out from Bharat Dynamics Management, they're very ambitious about the growth outlook, aiming to double their revenue within 2 to 3 years. Get a slice of this interview, and of course, we'll play it out later in the show.
Next year, we are hoping to be better in the perspective that we would be doubling our figures in about 2 to 3 years from now. And the way we have planned out our new orders and execution, we should be touching the tripling our turnover over a period of 5 to 7 years. The last year, we delivered more than 1,200 crores of export. This year, we are going to touch about 1,000 crores of exports. And on the export cycle, I would say we should look at a block year of 3 years when, you get fresh orders and then execution of that. So we are hoping to, we have got about 3-4 good leads in the export domain also. We are expecting that in a year's time, we should be able to close one more large deal on the export. And thereafter, for every block year of 3 years, if you look at a large order, that would be our agenda to have at least 25% of our revenue coming from exports.
So that's Bharat Dynamics. Of course, you can catch the full interview in about an hour or so on ET now. Let's talk. Let's continue to talk defense. Rajesh, do you like any names within defense, and what do you make of the moves that we are seeing? Any opportunities that you're spotting?
So Harsh, if we analyze the whole basket of defense stocks, most of the stocks are in consolidation. If we look at the behavior since last 3-4 months, most of the stocks are moving in very tight range and not able to give breakout of this consolidation range. If I go with the technical structure, the Bharat BEL is looking more promising. If I compare with all other peer companies, I think Bharat Electronics is still in the uptrend, and the way stock is consolidating at higher band of this up move, I think here there is a potential to extend its gain from the current level also. So buy and accumulate would be the strategy once stock manages to cross above 425 level. I think the next target on the higher side would be around 445, 460 zone for Bharat Electronics. So among this defense stocks, Bharat Electronics on a technical front is looking more attractive. But those who are having a little, positional perspective, buy and accumulate, they can look for stock like Bharat Dynamics as well as HL. Both stocks are in consolidation range. On the downside for Bharat Dynamics, the major support area is placed at around 1450. So that's the level where one can keep stop loss. Any breakout above 1600 may attract more buying action, and then possible really towards 1700, 1750 we could see it going forward for Bharat Dynamics.
Okay, that's the take coming in on BDL. Look out for Chalet Hotels today. There's an interesting note by Jefferies, of course, reacting to some of the investor meet takeaways, talking about the metro dominance at their analyst meet, citing institutional partnerships, mixed use expertise, industry leadership, the fact that they're now going to be focused on big box city assets and leisure properties, complemented by, of course, selective commercial real estate as well. So anyway, the management is saying that net debt to EBITDA is comfortable right now, and they have good opportunities for growth and clear visibility on that. Jefferies, of course, is maintaining their buy ratings on Chalet with the target price of 1,070 on the stock price, which does indicate a significant upside to the current market price on Chalet. But Sandeep, that's the other consumption pocket that you've liked for a while. We've talked about Indian Hotels, Mahindra Holidays, etc. And now you're seeing both Mahindra, Indian Hotels going to the next leap of growth phase. What do you like now within the hotels pack?
So Mahindra Holidays I don't like because I think they are
anymore.
not. No, I never liked because they are not consumer centric. So if you look at consumer feedback on what their experiences are in terms of trying to get a booking and all that, it's very difficult. So people pay, and timeshare I think in any case is a concept of the past. So now with the Airbnb and all those facilities available, so you don't really need a timeshare. So among hotels, the two stocks which I have liked and which we own also are Indian Hotels, because I think what they have done over the last few years and what they seek to do under the current CEO, and I think it's a very phenomenal story. And the brand is very strong and they continue to do well, and the demand supply for premium hotels in India still will be in favor of demand for the next 3 years at least. The other hotel chain which we like are Lemon Tree, on the more budget and business travel front. So they have also executed well. So right now going through a phase of consolidation, but I think longer term growth trends are also good in that. So these are the two we own, but overall as a space I like the space. I think it should do well.
What about the premium ones, Vente and others, Hotel Leela, they're the premium and ultra luxury ITC hotels is also moving towards that.
Even ITC hotels should do well. So, I think under post demerger there's greater focus. So I believe that even ITC hotels should do well. Other two I haven't analyzed myself.
Sandeep, but at these valuations, at these prices and IHCL, you would have bought them at lower valuations, I would reckon. At the current 740, 750 kind of run rate, would you continue to buy, or would you just hold?
So the stock ran up to 900 last 1 year. It's consolidated 700, 750. I still believe that it offers a 15-20% return potential, CAGR kind of, or maybe 15 to 18 from here. Not the kind of abnormal returns like who would have made, because like you said, you would have bought earlier. I remember that first we bought post COVID 92 rupees.
Correct.
So I think after that stocks done well, and so there's no incentive for people who are like you rightly said, hold or buy, because there's no incentive for people who have bought very cheap to sell because the company continues to do well. The challenge is for people who want to buy afresh.
Correct.
And I still think that among the large swath of companies available in India which have clear growth visibility with a very strong management, so Indian Hotels falls in that category.
So I think, what about this market fad with EMS, wires and cables, etc.? Do you think that sort of froth which was in that pocket has eased out? And what should investors be doing now?
So wires and cables had a very phenomenal run, but like paints with Ultratech wanting to get into that and all, we could see some sort of disruptions coming there. Not at the scale at which happened in paints, because in paints there were just 3-4 players. Wires and cables is much more spread out, and the valuations of these wires and cable companies are very high, because finally these are commodities. Like wires and cable are sort of commodities, so you can't ascribe 50-60 PE to these companies. So I guess they have had their day. Now we'll have either a time correction or price correction. So I don't think they present value at these prices. And the other one you were asking was?
No, the entire EMS play. That's exactly
the EMS. So EMS also, see, EMS profitability is largely driven by PLI benefits, and we have also seen a phenomena where companies have scaled up, then they have a disruptive profitability trend, so suddenly the growth slows down. For example, some large players which were big time into mobiles. Now, as the PLI benefits of mobiles get over in 5 years, we suddenly see that business come down, and then some new business come up where the PLI benefits are there. So government incentive driven companies trading at 100 P is very tough to justify when the net margins are maybe 2.5-3%. So people look at growth, but they don't look at where the growth is coming from. So it's the sustainability we have to track. Maybe they'll still do well, but I don't play that space.
Angel One came out with numbers earlier this morning, less than half an hour ago. I'm going to quickly take you through them. In fact, the number of trading days were 5% lower than last month, so you need to keep that in perspective. The average daily orders, which should largely be steady, have fallen 7.5+%. So that might be a concern, and I'm talking about month on month. I'm not talking about the YOY number either. And what you also need to look out for is the number of orders. Those have fallen 12.5%. So despite just a 5% fall in the number of trading days, you've seen a disproportionate fall in the number of orders overall for the month, as well as the average daily orders, which are all correlative. So you want to keep your eye out on an Angel One. I'm going to quickly take a view on charts. Rajesh, do you have a view on Angel One?
So since last couple of days, stock is holding about 20-day moving average, and again, especially in previous day, stock has shown a good amount of rally. Looking at the near-term structure, I think 2700 is the key level to watch for near-term trend perspective. If it continues to trade about 2700, I think trend is likely to exhibit on the bullish side. Looking at the recovery in last couple of days, now stock is approaching to its previous swing high of November itself around 2855. That's the key level to watch for on the higher side. Any breakout about 2855 may attract more buying action or short covering than possible extension of towards 2950 we could see. So those who are already on the long side of trade, 2700 needs to keep as a stop loss for near term to short term perspective.
Sandeep, within the capital markets pack, do you like anything at this point, given valuations and given the cyclicality of the business and the possible risks which it in any case faces from a regulatory standpoint as well?
Yeah, so risks are there obviously from in terms of margin compression, risks are there from the regulatory perspective.
Correct.
Overall, growth should continue because next year I expect capital markets to do better. So capital market stocks should also do better, and so we need to play more of annuity plays here. So at the right price, what people like the price. I think the best annuity plays are the asset management companies because in asset management companies, typically when people put in money, they will not withdraw. So the growth continues. So look at the right valuation, buy those companies. Then there could be companies like the exchanges where also the competitive intensity will be lower, and the brokerages I would put in the end because they are more transaction based, and transaction based businesses should not typically get very high valuations.
Given the fact, we've seen higher net buys from DIS, do you think that the investors normally channelize the money into mutual funds at a time when there is a time correction, or markets are sideways in that sense?
So mutual fund equity flows have been in the range of 20 to 40,000 crores. I believe they'll continue to be in that range if the markets remain steady, because saving into in equities, like equity investing is now a phenomena which is not going to reverse. So people think that 2-3 months or 6 months market don't do well, people will stop their SIPs and all. That's not going to happen. Unless and until we have a full blown bear market where people lose big money over a 1 or 2 year time frame, I don't think equity flows into mutual funds or the overall ecosystem of mutual fund, PMS, AIFs, all that is going to reverse.
Sandeep, since you did touch upon Asian Paints, time, price correction, all of it behind it?
I think so, yeah. Because we waited for 4 years to buy that stock. So I think it's a question of this is a good company, but you don't want to buy at this price. Business getting disrupted. But I think earlier during this year, my view was that the intensity due to Birla Opus now seems to be peaking out, and from here on it should do well. So I think that phenomena I believe should play out. I think it will again go on a growth path with decent margins, and next 2-3 years should be good for Asian Paints.
So still a good price to buy at 29.54?
So a hugely owned stock, it became a very under-owned stock, and as the revival cycle plays out, I think it should do well. Now, whether this price is good or not, I don't know. So we got in at around 23.50. So I believe that was a good price. Even this price should be decent. I don't think it will correct big time. But it's not a stock which is going to give you 50-100%. Like it's a stock where you should expect maybe 12-15% kind of returns, which is also very good return. People want to invest in equity markets to make 50-100%. Like you don't need to look at every stock like that. There are some stocks you buy for steady returns.
True.
Bank of Maharashtra was the other one in focus yesterday. There was a block deal there, and the PSU banking stocks in general, Sandeep, have done very well for themselves. In fact, what we've done is we've done a small explainer on what Bank of Maharashtra has done in terms of the rally this year, and the PSU banking index has done, along with the Nifty Bank. Mithali is here to talk about all of the to talk PSU banks, their dream run, and also give us some perspective on Bank of Maharashtra. Mithali.
Talking about the stocks and news, we have IRFC in focus today after the company has signed a major loan agreement with SBMC via its Gift City branch in Gujarat, and under this agreement, IRFC will be raising ECBs worth $300 million denominated in Japanese yen, and these funds are expected to support the financing needs of Indian Railways.
We'll leave it at that. Thank you so much. By the way, Bank of Maharashtra, of course, some bit of the overhang going away because the OFS came through. And now the government of India owning less than 75%. What they've guided for, that credit costs will be sub 1% going forward. They're well provided for on their book. They're doing a decent ROA clip. They're trading at 1.4 times price to book. So valuations seem reasonable as well. And the commentary seems to suggest that they can sustain some of these numbers. Sandeep, Bank of Maharashtra in particular, but otherwise the PSU banking pack, is it really standing out in comparison to private banks, and is that why there is a potential for re-rating there versus the private banks, where also there is some potential, but better potential in PSU banks. Is that the view you sit on?
So it's a valuation story, because at various points of time valuations become depressed, then they catch up. So I think that catch up on valuations is happening, and that also in PSU banks mostly happens once SBI moves. So first SBI moves, then all these stocks follow. So I don't buy very small banks, but because I think in smaller banks suddenly things can go wrong, and in financial we need to reduce risk. But I think the larger PSU banks will do well,
Larger as in SBI.
like SBI or a Bank of Baroda or
And
those
bank
kind
itself.
of
Union
things.
Bank,
Yeah,
Canara
yeah.
Bank. Yeah.
I think
Okay.
all of them should still do well.
Sure. And the risk reward there is favorable versus private banks. Is that what you would feel?
So I would think risk reward is balanced both sides. It's because private banks have not performed for a long time. We have seen PSU banks do very well. So next year we could actually see private banks also do better.
So if I were to push you to take a pick between PSU and private, where would you sit?
See, I can tell you what stocks we hold. So we hold ICICI Bank, we hold Axis, and we hold SBI. So these are three I own
Fair.
at this time.
Okay, understood. Sandeep, the other pocket, off late it's been a little depressed, real estate. With all the renovation that all large cities are undergoing, including Mumbai, what's a good realty stock to buy at these levels?
So I think realty, the news flow on the ground is very mixed. So the general story seems to be that there was a big up move, but then there's a slowdown, especially in the NCR region where there's inventory built up, some correction also is happening. So, but overall interest rate trends in a reducing interest rate environment, typically real estate will continue to do well. So the best play there I still believe is DLF with their deleveraged balance sheet, and it's also corrected. So I think that at around 700 levels, I believe is decently placed.